Thank you, Christina. We commented on our results as well, pleased but not yet satisfied. I think, again, when you look at the hit we took on tea and the fact that we made our forecast, that shows you that we are robust. We are able to take some blows along the way and still deliver on our commitment, and I think that's really the message to take away going forward also. Which is what we're going to do now. We're going to move into the forward-looking part, into the strategy. And I think the best place to start the strategy going forward is kind of where we began with the strategy in 2017, February 14, 2017 to be precise. At that time, this is the picture we showed you, so no change. What is interesting is that at the beginning of 2019, Christina, new on board, said, convinced me the strategy still holds. So we actually had quite a few sessions early on in the year testing our assumptions. And bottom line is, yes, it does hold. We're going to show you why. And at the time, we told you 246, so 2 segments, 4 regions, 6 key industries, and then the recipe to win through our people, customers, innovation, organization structures, and delivering on the financials. That really hasn't changed. We showed you at the time as well the 3 horizons. In the stabilization phase, that was 2017. We had 1 legacy project then that really took us down. We made a profit warning in Q2 of 2017. Since then, we've stabilized. And as I said, events such as happened in tea, although they set us back, they don't knock us over. We still deliver to our commitments, and I think that's our mantra going forward. We deliver to our commitments. We've gone through the stabilization phase. All of those lines have a check mark beside them. We did the same on the build-up phase. And now what's left ahead of us, with a little bit of delay, but it's still ahead of us, is the build-out phase. And the build-out phase, when I look at that, the first question you ask, well, what did you make in between? What did you miss? And just summarizing, where we wanted to be at the end of 19, where we committed to be at the end of 20. And this is, again, going back to our original February 14, 2017 Capital Market Day. We said we would grow the top line on the base of 2017 at a CAGR of 5%. Okay, you've seen we're growing at 6%, a little bit stronger than that. But again, give ourselves a check mark. That one we achieved, and I think we'll continue to do so going forward after a pause on the order intake 19 converting into revenue in 20 for good reasons. On the gross margin, we failed. Quite frankly, we failed. We said a 200 bips pickup. We're more or less at 0. There's a nice trend that Christina just showed you in Q4 and a smidgen of a trend on 19 over 18. But we face it. We haven't delivered there. There have been headwinds against us, but we're not going to sit here and moan about the past. We're going to look forward, and that really is our major target, our major to-do, and we're going to explain to you how we're going to achieve that. SG&A, well on the way. We said 300 basis points, so down from 10.5 to 7.5. We closed the year around 8, so we're 250 of the 300 are in the bag. And this year we'll do the remainder. So we will make our 300 basis points reduction in SG&A, and we'll take it further from there. So again, check mark, we delivered. On the target margins, we said the target margin for maintenance was 3 to 5.5%. We're there, we're at 4. We will improve upon that. We're not sitting back. I'm just saying we delivered. Likewise, engineering technologies, we gave you at the time a target of 5 to 9. We failed. We're at 0, even a little bit below 0. So if you break it down into the 5 companies, different story. But we're not complaining. We're just sharing with you our report card. And as Christina said, we are absolutely transparent on this. Finally, on the free cash flow, again, check the box. We said by 2018, we'd be adjusted cash flow positive by 2019. Reported cash flow positive, check the box, 57 million, we achieved it. So what's left is to deliver on the remainder of our commitment. This is why we gave the strategy a little bit of a twist. We'd called it now 2020 plus. And early into the next plan period, being 20 through 24, we will hit the mark and we will deliver on our financial ambitions. I'm going to go more into the forward mode, and to set the scenes, we have prepared a small film just as an emotional stimulator, but I think it'll give you a little bit of a preview of what I'm going to talk about, and therefore it's a good backdrop. So with that, if we could show the film, please.
At a time when elemental changes are happening at breathtaking speed, forward-looking businesses need a reliable partner with fresh ideas. Climate change poses a historic challenge. What's called for today are sustainable concepts that will reduce carbon emissions and foster circular economy systems. At the same time, the average age of industrial plants is rising year after year. Maintenance and the ability to extend the asset's life cycles are becoming more and more vital. Digitalization is profoundly transforming industrial processes. Intelligent, trend-setting solutions and capable partners are urgently needed. But well-trained and skilled people are getting harder to come by. That means outsourcing services beyond the scope of the asset owner's core competencies will become more common. These trends will shape the future of industries across the world, and they are driving Bilfinger's approach to business. Building on decades of experience, Bilfinger constructs, maintains, and modernizes industrial assets across many different regions, all with different requirements. Whether it's extending life cycles, boosting efficiency, or enhancing sustainability, Bilfinger has always been linked to the process industry through long-term contracts and cooperation with its clients in a spirit of trust. Based on this comprehensive expertise, Bilfinger turns data into value by making plants smarter and more transparent. Innovative solutions leverage the full potential of artificial intelligence, augmented reality, or cloud-based system networking, and pave the way to success for asset owners. Bilfinger's people are its most valuable resource. They're not only well-trained, but also committed and highly motivated. Bilfinger's people work to exacting standards using concepts such as BMC or BTC, which guarantee the highest level of quality and safety. These three factors bring the success of Bilfinger's two business lines to life for asset owners. The portfolio of services covers every link in the value chain under one single brand, Bilfinger. That's what makes Bilfinger the perfect partner in helping its clients meet the challenges of the digital age even better. We make it work.
Okay, time to move around a bit. When we reviewed the strategy and decided it was the way to go forward, we spent some time looking on the global trends, and of course everyone has these, but we focused on the ones that we felt were particularly applicable to us and that would change and drive our business going forward. I think no surprise in the first one, aging assets, asset integrity. This is, I think no surprise. If I go back to my early days, in the North Sea, the assets I worked on then are alive today. They're written off, they're being extended. The same as on land. So, companies are stretching their asset lifetimes. At the same time, they're stretching the assets themselves. They're trying to drive efficiency. They're driving emission reductions. All these are areas where Bilfinger can step in and help. At the same time, as these assets get older, like people, they of course need more maintenance. So the maintenance costs continue to climb. And therefore, this is a prime focus of what we do. What I described covers the asset base in Europe and in North America. If I go to the Middle East, the assets are more like teenagers. They're still young and strong. The customers paid a lot of money for those assets, so they bought top quality. But those assets are being run by quantity rather than quality. And therefore, when they look at their benchmarking, they see that they're not on a par performance-wise with other parts of the world. Therefore, again, they're looking at people like Bilfinger to come in and begin to drive performance. The second driver, ESG, climate change. I think the G part, governance, we've learned our lesson, we've gone through that, check the box. Social, yes, but environmental, we have a role to play. We help our customers achieve their own goals. So we deliver on reduction of CO2 limits, emissions and air pollutions, clean energy, distributed power generation, power to liquids. We were asked this morning, what is that? It's if a windmill is driving power generation, driving electrolysis to generate hydrogen, for example. That's what power to liquids is. Circular economy, converting waste into materials, into chemicals, or converting waste into power. All of these are projects that we are engaged on today with our customers, helping them achieve their goals. We also notice that the flow of finance is changing. People decide where to put their money, and ESG is a prime factor in deciding where that money goes. We like our customers to have money because then they can give some of that to us. And then finally, of course, is the Green Deal. You will see it coming later on this year from the EU. Again, it will play in this direction. The third trend, and this is not something we make up to drive pricing, this is a fact. There is a skilled labor shortage. There's one in Europe, driven by demographics, so people getting older. Also driven by the younger generation's appeal to digitalization. They want to go work almost everywhere except in plumbing or welding or in scaffolding. Now, we're very fortunate that we have a good reputation. We can still attract these people. But it is a fact that in Germany, almost a third of these typical skilled labor apprentices positions are empty. In the US, it's a little bit different. It's not the fact that the people are getting older. It's because the demand is higher. And if you look at the US and look at some of the headlines, you'll see that plumbers are being moved, relocated across country. So a plumber that would have grown up in the town where he was born is now being paid tens of thousands of dollars to relocate to another part of the very large US. Again, shrinking unemployment is driving that, and that drives a craft labor shortage. We have that craft labor. In the Middle East, I alluded to it at the asset part of our trend. In the Middle East, problems were solved by quantity. If you had a plant that wasn't performing, you threw another 100 people at it. It really wasn't expensive. That's changing. So as they begin to benchmark, look at performance, and also begin to squeeze their assets, they're saying we need to upgrade our people. And there, again, Bilfinger can help. Finally, I think, again, no surprise, and I think none of these really are a surprise, but these are the ones that drive our business. It's all about data. And data is everywhere. Artificial intelligence in terms of machine learning, that's beginning to have an impact. It's early, but it will have an impact. The machines will learn and replace the experts that we're losing. Predictive and prescriptive maintenance, we've described that already to you. I think virtual reality and augmented reality, combining the virtual world with the real world at the same time, one eye here, one eye there, and then being able to access machine learning to do a better job and drive performance at the plant. We look at OEE, overall equipment efficiency, and again there, as people try to sweat their assets, as they try to squeeze out more from the existing plants, this is where digitalization plays a key role. Also, if you understand your plant and can model the data and predict, it means you have a better handle on risk. And I think understanding risk around plants opens up new business models that I think you'll hear from us a little bit later on in the year what exactly we mean by that. So these are the four trends, and I think you'll agree these trends all affect and drive aspects of our business. So what do we do with that? Well, there are three core capabilities we have that we believe are needed to address those trends, and again, which make Bilfinger a little bit different from some of our competitors and position us well for growth. So the first, of course, is our very strong, skilled labor base. We are number one in Europe. I'll show you some numbers. We have a leading reputation as a good employer. We invest in branding, employer branding, which means we actually go looking for the right recruits. Before you could sit back and wait. Now you have to go and look for them. We have an academy, so we not only get people, we train them, we invest in those people. That makes them stronger, better, and again, it's an attractive feature of Bilfinger as an employer. We have accreditation for our tradecraft. We had at the end of last year 34,120 employees. Those are full-time employees. At any time, we can add thousands of part-time. We have a very large register of people that want to work only on projects and then go home again. So we have what's needed. We have the skilled labor base. We have domain expertise. Customers like working with us because we're engineers. So we can go into their plant, we can talk to them about processes, we can talk to them about where to drive efficiency, about debottlenecking plants. They like that interface, and this is also why we like the engineering reputation. Now, we're struggling and fighting with it, we're not giving up, but I think, again, that's key to our makeup and our credentials vis-a-vis the customers. We focus on the same key industries, you know what they are. We're close to our customers, we're intimate with our customers, we collaborate, and I think the long-term contracts we have, they attest to that. Our longest customers, 75 years they've been with Bilfinger. Our longest term contracts currently running, 14-year contract, Equinor in Norway. And once we win a customer, we rarely lose them. And if we lose them, it's rarely, very, very rarely for quality or not achieving the cost reductions that we committed to. So our stick rate is more than 90%. And something we can do that others cannot do is we can work across borders. So if there's a large turnaround in, say, Antwerp, we can mobilize hundreds of people from across Europe to that turnaround. When it finishes and there's a turnaround then in Schwechat in Austria, we can move those people and add to them in Austria. We are cross-border. Not everybody can do that. That makes us a little bit different. And then finally, digitalization. We created Bilfinger Digital Next 2 years ago. It's a startup. It's consuming money. We planned for that. We said we have a 3-year horizon to get to break even. They're on the way. But what we're realizing is they're actually a very strong marketing weapon. They differentiate Bilfinger again from others. And Duncan will point to an example where we won a contract just very recently because we have this. Not because it's doing something wonderful, but because the customer says, you're innovative, you are forward-thinking, we want to work with companies like Bilfinger. And then we converge the BMC, Bilfinger maintenance concept. This is our numerically driven approach to doing maintenance, now augmented by digital towards digital BMC. Not only do we try to benefit the customer, we also want benefits from digitalization. And some of the shots you saw in the movie, they're around electronic workflow, where we drive internal efficiency. And if you're on a unit rate contract, you're paid a fixed sum for a pump or a motor. If you can lower your own cost by being more efficient, that's profit. And therefore, again, we use this internal to drive forward our margin expectations. We also have AI. We have PIGgraph, which we've shown a few times. What is PIGgraph? These big A3 size piece of paper that describe a process in a plant. P&ID, piping, instrumentation, diagram. Some of them handwritten, changes on them. We can feed that into our PIGgraph machine. It reads it. It converts it into a process flow and puts that into a computer model. So we're able to archive old manual process flow charts, but also use that to build digital twins. And then finally, as I said, when you understand risk and how a plant performs and what the consequences of that risk may be, it opens up new models for you. And we're having discussions with a couple of people to see if we can use that to develop new partnerships for Bilfinger and take us into new business models. But I'm not promising on that yet. It's work in progress. But it shows you there is more under the blanket than meets the eye. So these two dimensions fit together. And we could put a lot of pictures on this chart, but I'll walk you through them. Fabric maintenance, North Sea, that hasn't changed. We're a lead in that. We're very numerical with our maintenance analysis. We build twins in order to drive digitalization and to do predictive and prescriptive maintenance. In terms of ESG, climate change, we support our customers, help them reach their goals. The picture you see here is a circular economy where recycled plastic is being converted into a fuel which is augmented in the cracker feed in order to drive, again, circular economy. We do something similar with municipal solid waste, which is turned into sludge and then, again, goes through a pyrolysis system to generate power. These are still prototypes and drawing board projects where we support our customer with their targets, their goals. Again, it shows you that we're, I think, a little bit ahead and doing things that some others would like to do. Biomass-fired fuel stations, easy. Non-cellulosic ethanol, yes, doing that too. There's a lot of stuff we're doing around ESG and climate change. Pollution. For many years, we've been doing desulfurization in coal-fired power stations. You know the scrubber approach. I'm sure you're going to have a few questions on that later. But also, we use scrubbers in cement works. Just down the road here in Enegalo, we have a project where we're actually taking the sulfur out of the cement emissions. We're being contacted by many customers who are focusing on CO2. And last but by no means least, we do a lot of work on water. The picture you see here is Thames Water. We're working with them on their efficiency drive in the UK. But we also maintain and also operate partly desalination plants in Kuwait and in Saudi Arabia. So we are very present here, and as this develops, we think this will be a very strong driver. We have the answers. We have the people, we have the domain expertise, and we have the digital answers in order to put this together as a chain. I mentioned this already, employer of choice. We have the right training and concepts. We can go a little bit further by making the job more interesting through augmented reality. We do cloud analytics, we have AI, and we have now digital BCAP. I think we have the recipe in order to deliver on the kind of strategy that we're showing you here. We then spent quite some time discussing the essential elements like the assumptions. Making a plan going forward is fine, but you need to make certain decisions. What are you assuming is going to be a constant through this 2024 period? And for us, and bear in mind this is our organic plan, it's not talking about adding to the picture through acquisitions. This is the organic growth plan. We still remain focused on the 3 key regions. Our house that I showed at the beginning is intact. Europe, North America, Middle East. Our industry focus remains the same. 6 industries, the top 3 generate 80% of our revenue. Digitalization, we see as an enabling opportunity, not just per se, but enabling, driving productivity internally and opening up new opportunities for partnerships and different business models as we get mature and show that we can really anticipate risk and predict events in plants. We're assuming that we will be engineering and maintenance for a while yet. We're not defining which companies are inside of the technology part. I'm sure that's a question later on too. But again, as I mentioned, there is a good overlap there. There is a credibility aspect to it too. And we think that we can grow further in E&M, strengthen our strength. The war for talent, blue collars, we do make a difference on the market. And we do believe that we will have to fight for good people through the entire 5-year period as do other people. But we think the cards are stacked in our favor. We think we have the right tools to do that. And therefore, this is something that we will continue to do well, I hope. That is attract the right kind of people to deliver on our business model. We then went into the imperatives. What are the essential must-haves we have to deliver? And I know margin, okay, but we also have some other factors, integrity and HSE. We learned the lessons, made through mistakes in 2003. That was a hard lesson, the DPA. It took us 5 years. I think this is the strongest angered culture element throughout Bilfinger. Talk to anybody in Bilfinger, all 34,120 people, they will recite to you our compliance rules. We will not compromise on integrity or on HSE. People, attract, motivate, retain, develop. Unique service offering, we want to be able to offer our customers, not just one service, but a number of services. We want to be innovative, and we want to, over time, extend our portfolio. We focus on an asset-light model. When we're often asked, about M&A, we have a vision of what M&A looks like. We could describe the animal to you. We couldn't put a name on it because we're not there yet. But what we can tell you is that it would be asset-light. We're focused on ROCE. So ROCE is one of our primary factors of success. and to drive ROCE, of course, not only being asset light, but strict working capital management and very disciplined M&A criteria, which Christina will touch more on as we step through the presentation. Margin growth, it's not just pushing for pricing. And of course, as there is a shortage of good people on the market, we've got to be able to push back on pricing. And a lot of our managers over the years have become a little bit soft and let themselves be rolled over by the customer. That's change. It's changing. I was very happy when at the beginning of the year we renewed a contract in Europe, and we told them, you're not renewing unless you increase the margin. At first they were saying, are you serious? Customers always expect a deduction, a reduction. We said, yes, we're deadly serious. You don't get it, we will not renew the contract. And surprise, surprise, the customer renewed at a higher rate than before. You've got to drive that behavior throughout our organization because people are a shortage. We have them. We have good people. We will make a difference. Likewise, project execution. You know my song and dance on that. We're not done yet. There's room for improvement. And again, we know where to apply that improvement in order to generate the margin pickup that we've promised. And then finally, portfolio rotation, something I mentioned last year, not off the agenda. We will continue to look at that, taking out the low-performing companies, replacing them with more interesting margins. SG&A, not going to go into depth on that. We're on the way. And I think also important is our geographic footprint. We know what to do to grow our business in North America. We want to leverage our existing customers and market position. We want to push more into maintenance using what we have in Europe, but also now with digitalization approach. And likewise in the Middle East, we've been in the Middle East a long time, more than 60 years. And if you look at our revenue base, it's about 80% is energy and utilities. Only about 20% is oil and gas. Surprise. So biggest oil and gas market in the world, we can grow there. We have our first contracts with Aramco. We mentioned that last year, the Berry gas compression project. We've just won a great project in Ruwais in Abu Dhabi, working for a well-known customer there. Again, Duncan will touch on it. So it's working. We're on the way to driving our oil and gas profile up from where it was in the Middle East, and that's an essential part of our growth. Now, it is a small part of our business, but nevertheless, it's growth, good growth, and profitable growth. When we sit down with most of you one-on-one or in other parts of the world, the first question that we're always asked by the analyst community is, how do you see the market? What are your customers telling you? And the way that you ask us these questions, you expect us to come with a negative answer. Sorry, we don't have it yet. Our markets are thus far robust. And if you look at our markets deeper, and I'm sure you do, you know them better than we do sometimes, they are long cycle markets. So when they do tip, when there is a recession, we see it coming very early. So our customers go through a longer cycle. We see it coming earlier. We have to react, of course, when that happens. It hasn't happened yet. If we look at some of our main businesses, if you look at the chemical index, petrochemical global index, in the 5-year period, 20 through 24, it shows 5.5% CAGR. Now, a lot of that is in the Far East, okay? So if you look at Europe, look at Middle East and North America, it's a little bit less than that, but it's growth nonetheless. That market continues to grow. And really, it's growing with population. People want to have more chemicals, textiles. Population growth is driving the petrochemical business, and it's not going to go down even with a blip in China as we're seeing today. CapEx, OpEx around E&Ps, exploration producing or oil and gas companies. People are saying, well, the oil price is down a couple of dollars. Are you feeling it? If you look a bit deeper again, and Total's a great example. Total is a major customer of ours across Europe, in Germany, in Leuna, in Antwerp. And Total, again, you know it better than I do, last quarter, $7.2 billion of cash. That's 20% up on the same quarter 1 year before. So despite a $2 oil price reduction, they're driving more cash. They have their costs under control. They're driving productivity. They're generating cash, and that goes into asset life extensions, making sure that maintenance is working. Our customers, for now, touch wood, are solid. Our industry is robust, and we're confident that we will generate revenue growth going forward for those reasons. The old reasons, asset base, Refineries are old, more than 20 years. If you look in Europe and North America, 60% of those refineries and assets, more than 20 years old, they need us. Likewise, they keep adding new ones. It's not that the old ones are being torn down and new ones replacing them. No, the old ones are left and new ones come in addition. And we see 45,000 assets in our space. And we see new projects, even in Europe, which is a mature market. Look at Borealis, look at Ineos investing each a couple of billion in Antwerp again. We're in Antwerp, this is good for us. Climate change, okay, you know the story better than I do. Again, I don't need to dwell on that one. But we're the ones that help our customers reach their climate ambitions. And again, today, I think it was on Bloomberg, Mr. Looney being interviewed. BP wants to be CO2 neutral by 2050. That's a tall order. Happy and waiting for the call. So a few more credentials. We say we're number one in Europe. We think the European E&M market is roughly 25 billion euros per annum. If you look at where that money is spent, a large part is in the North Sea. A large part of that is on the UK side. And that's why, the single biggest market, and we're looking at the size of the little factories here that my colleagues put together. You see the largest factory there, the largest market is in the UK. That's driven by oil and gas. The largest land market, of course, is in Germany, and then so on and so forth. And you see our position. We're number 2 in the UK. We have some big peer groups in oil and gas. Number 1 in Europe. Look at the Lunendonk study year for year for year. We're number 2 in Bene, Belgium, Netherlands. Number 1 in the Nordics. Number 1 in Poland. Number 1 in Austria and Switzerland. And we didn't just do that to make Christina happy. That's a fact. So when you put it all together, we believe we are the number 1 E&M company in Europe. As I said, we're a people company. Bilfinger is a people company. We don't have factories or manufacturing in large scale. We do small modules. We're all about people. And therefore, our people are they're not only our most important asset, they're almost our only asset. And that's why we protect them, nurture them. And if you look at the numbers down here, bottom right, we ended up the year with 34,120 to be exact. That's down from 35,900 last year, despite higher revenues. So, we're driving productivity. But the main delta there between the 35,900 and the 34,100 on my chart is that we have been selling companies, including large manpower companies in Austria, for example. So we're focusing on efficiency. And again, if you look at the chart and look at the balance, we have a good mix of white collar and blue collar. Again, driving our credentials, working with our customers. And the E part of E&M is engineering. The customer says, I need a modification, I need improvement, I need less emissions. Can you engineer them? Can you implement them? And that's why the two go hand in hand. What have we been doing to protect our most valuable resource? Well, we've done a lot of things and continue to do so. So some of the more recent ones is focusing at the top end on management. And I shared some numbers with you last time. We have changed a lot of managers. Where change management doesn't work, we change management. Critical entities, right sizing, that's part of the technology story. It's one of the companies there taking it down to the point where it's right sized, but not too far, so it doesn't come its way up again as the orders come in, as they're doing now. Hercules, we've invested a lot of money in SAP SuccessFactors that we call HRQless or Hercules. We have the Bilfinger Academy. We consolidate LEs because, I said it last year also, I think that 5 times 60 million is not as good as 1 time 300 million. A stronger management team, stronger delivery model, and of course, a more focused approach to the business. And then finally, SG&A efficiency. It's not just about cutting heads. It's actually being more efficient, checking off the boxes, empowering the people. As we go forward, we have a very active skilled labor strategy. We're beginning to focus more and more on first-level leadership. These are foremen and shift leaders, and I'll show you why that's so important. Critical positions remain project managers for execution, but also here, this one, contract manager, in order to claim. Customers like to take advantage of you. If you're not prepared before you start the job, then you will be eaten for breakfast. And that's happened a few times. As you know, it's going to stop happening in the remainder of the company. Most of it is fixed. Cross-border opportunities, I mentioned that. We can move around, others can't. Entrepreneurial empowerment, Duncan will dive into that one. And pay for performance. Christina mentioned a quarterly approach to cash management in order to get away from this bathtub profile. We want to see 4 nice peaks through the year, or ideally a flat line. To show you some real numbers and some real evidence of what we're doing, this is from social media. This is the kind of thing we do out there to attract the right kind of people. Is it working? That's over here. So we've had 23,500 applicants since we went live with this, and live was at the latter part of Q2 last year. We've made offers to 1,900 of the 23. We are picky. We don't just take anybody. Picky is Christina's word. We've accepted 1,400 people into the company, or rather they accepted to work for us is probably the better way to explain it. That's a 75% hit rate on what we select. And we have in the machine now 30,400 candidates that we can go to. So you see, employer branding is critical, it's important, and it's part of our makeup. It's what drives a little bit our thinking going forward, because this will not change in the next 5 years. I think I mentioned some of these issues, wage arbitrage. We move people around Europe also for wage regions, and they even like that. It's motivational. Now the graph on the bottom left of the chart, interesting one. The first part, the 4 sites, this is where we actually went in and worked with the foremen, the people that have 4 or 5 people working for them, building a scaffolding tower, for example. We went in, we spent time with them, we talked about motivational principles, KPIs, morning briefings, performance targets, and after only a very short period of time, we saw a 30+% increase in productivity. And then again, we went forward in measuring that in terms of cubic meters per man hour, a 56% increase in the amount of scaffolding that people can manage. Once you begin to pay attention to the people, give them KPIs, treat them like managers, invest in them, amazing things happen. I'm going to try to finish off with a little bit of where the revenue growth will come from. I've shown you why it will grow. I've shown you why our markets are intact, why we think we have the right recipe and resources to address the markets. Our model going forward will sustain 5% CAGR. We commit to that. We see that within our geographic horizon, the biggest growth on a smaller base, of course, will come here from North America, rolling out E&M, followed closely by technologies. I think you understand why. Middle East, 7%, and Europe, our largest base, grow a little bit slower, but we think here this is a profitability challenge, this is a top-line challenge, and all of that together adds up to the 5% CAGR. We've broken it down also by industry, our 6 focus industries. This one sticks out. That's the Hinkley Point effect, okay? And it's also why then, in technologies, there's good growth. Hinkley Point coming in, turning from orders in 2020 into revenue in 2021. So with that, I'm going to pause. I'm going to hand over to Duncan, and Duncan will dive a little bit deeper to give you examples that substantiate what I've been showing you.